Guys, I want to talk to you about a hidden chunk of houses that are bound to hit the market. Okay. So everybody knows that the high prices in some of the regions in the United States right now are because of low inventory. So it's clearly not because the rates are low. It's clearly not because people have expendable cash. The rents are high and the inventory is low. And that's what's keeping house prices up in some areas of the country. But I believe that's short lived, and I'll tell you why. There is a huge portion of houses in these same areas that are devoted to short term rentals, or STR, Airbnb and Verbo type rentals. The reason they're there in those more expensive markets is because those more expensive markets are fun places to visit, places people like to vacation. But there has been, according to Yahoo Finance, a 50% decline in the short-term rental income. For instance, San Antonio, Nashville, Denver, New Orleans, Seattle, and Orlando, places that are huge vacation destinations, all saw revenues drop at least 34.8% from May 2022 to May 2023. Listen, there's reasons for this other than just the fact that people's expendable income is shrinking. We did see when people were concerned about going places because there were lockdowns, they didn't want to be around other people because didn't want to get sick. They were using these short-term rentals in lieu of hotels. Since then, cleaning fees have gone way up. Fees for the websites have gone up. People's are returning back to hotels and motels where they can get special deals. It's quick in and out. It's easier. They don't have massive cleaning fees. They don't have the same restrictions that they had to worry about before. Not as many people are worried about being around other people now. So the benefits of having short-term rentals has gone down dramatically in the last couple of years. In addition to that, there have been more short-term rentals that hit the market because it's been a hype. Everybody's talking about how they were getting rich with these short-term rentals. People were doing rent-to-rent, where they would go out and they would sign leases and then they would turn short-term rentals into them. All of this contributed to raising rent prices at the same time as taking houses off the market that could have been for sale. And so then that raises the price of houses because the inventory is shorter too. But as these people who they're not their primary homes, so they need to get rid of houses if they're not going to be turning a profit. And if they're not going to be renting them out because hotels are becoming more attractive and less people are utilizing them because it's too expensive. And then the competition is getting stiffer on these short-term rental sites, so they're not going to be able to compete. Eventually, they're going to have to throw in the towel and these houses are going to become available. That's not going to be a house where somebody could just say, oh, I'll just stay there, right? These people are going to be coming out of pocket for a house that they can't utilize. One of two things is going to happen. They're going to have to turn them into mid to long-term rentals, or they're going to have to sell the house. And they'll probably choose to do so while they still feel they can get some of the equity from these huge run-ups that we've had over the last 1 or 2 years. If that happens, regardless of whether it goes into the rental market or whether it goes into the for sale market, it's going to drive prices down in those segments when the snowball effect happens and more people are doing this. So we talked before in a previous video about the hidden housing market crash that I had noticed because so many people were buying down rates when they were selling their houses that were included in the deal. And something else I thought of, if you've watched that video, then I didn't mention that that's actually costing the homeowner more out of pocket forever in many cases, due to the elevated sale price and the correlation that it has with property taxes in that area. Now, some areas only go off assessed value, but some areas, when you buy a house, that becomes the new assessed value. So it's not always going to cost more forever, but in some cases it will. In my particular case, it will, because in California, when you bought a house or you sell a house, the sale price becomes kind of the new default assessed value a lot of times. And from that is your property tax base. Now, if prices crash, in the meantime, you can appeal it and get a lower property tax base to begin with. But when the prices go back up, your property taxes go right back up. So I can't remember which proposition it is in California, but there's a proposition that keeps your property taxes from going up over 2% per year. If you say you buy a house for $500,000, it crashes to $300,000, you can file an appeal to get a temporary reduction in the base value of your home for property tax purposes. That will lower your property taxes to be based on the $300,000 assessed value. As soon as houses go back up, your property taxes can immediately go back up to what it would be if your house was $500,000, which is different than if you bought the house for $300,000, because then your house could only go up incrementally 2% per year. I know this, and some people out there might not understand it or might try to argue with me, but I know this because I've been through it in the crash of '08. I had bought a house in 2006. The house I paid $324, I believe. It went up to about $390 at one point in time, then crashed to where it was worth about $190. And during that period of time, I filed an appeal. I got lower property taxes on the house. But when the house prices started going back up, my property taxes quickly ratcheted back up to what they were when I had paid $320 for the house. On the flip side, the people that walked away from their houses could have bought a house across the street from themselves at half price and permanently had lower property taxes than I did. So essentially, not only is there the benefit of potentially walking on a mortgage that's higher, which it didn't work for me because I had actually put a good down payment down, and I wouldn't have done it anyway because I still would have made $100,000 by walking on that house, but I didn't because I pay my obligations. However, the people that did walk on their house could immediately walk across the street, buy another house, and have lower property taxes forever. And I know that because I have several friends or acquaintances that did just that. They bought another house, and this tells you they chose. People always tell me, well, people don't just choose to quit paying their mortgage. They can't. They're in trouble. And that's complete BS because I watched them qualify for an additional house, buy an additional house, and then walk on the house that they had. So I guarantee you they were able to make the payments because they qualified to make the payment twice. That tangent that I went off on doesn't have anything to do with the Airbnb market. It was just an added note about how the hidden housing market crash of these rate buy downs is going to affect people long term, and I don't know that all of them have actually thought about that. But even in the area where I am at now, in the Northeast, where I moved from the West Coast to the East Coast, when I went from the West Coast, I had sold into a little bit of a dip because it was coming into winter. The rates had just started to rise, so I got a little bit less for my house than what I had originally anticipated that I would get. In the meantime, prices back here continued to skyrocket, and so there was quite the spread where originally I had anticipated that the house out there and the house that I bought here would be approximately the same price, give or take, $20,000 or $30,000. Now the houses back here for an equivalent house are $200,000 more because in the 2 years it took me to get a transfer and sell my house and move, things went haywire back here and they took a dip out there. However, I am starting to see a lot of price cuts here. 6 months ago, all the houses that you saw sell were selling for more than what they were listed at. Now I'm starting to see that after they're sold, some of them have taken $20,000 or $30,000 less. So even in this hot market, this huge vacation market up here, where there are a ton of short-term rentals, things are starting to cool. As they start to cool, people will quickly try to get out with whatever equity they can. And that will drive prices down even further to the point where people don't have the equity that they need. And then that will cause them to either walk on the house or get foreclosed on the house or sell just to try to break even on what they paid for it a couple of years ago. That's what I anticipate. Obviously, this isn't financial advice. I can't tell the future. Every time I try to, I'm wrong. But that is what makes sense. And a lot of people say, oh, it's different now. It's not going to happen again. It's not going to be like it was before. It may be true. And it may be true in the sense that it's going to be worse than it was before. I have no idea. All I know is that people think that rates are going to go back down, and rates only typically go back down when the markets are crashing and when people are out of work. And by then it's too late. It takes a while for it to play catch up, and after that, then it makes a U-turn. But when rates initially start going down, that does not necessarily mean that houses are going to go straight back up, even though every realtor and loan officer that you talk to will say that it does. And every one of them will always pick apart anybody that says it's going to go down, and you have to wonder why. Okay, if you're in the business of selling widgets, you're never going to tell anybody that widgets are worthless. That's all I have to say about that, and I will talk to you later.